All right, moving on to matters financial now. The Standard Chartered Bank has posted a 36% increase in its pre-tax profit to stand at 17.1 billion shillings. According to the lender, the increase was due to the reopening of businesses after the COVID-19 pandemic. And at the same time, the lender says it will be paying its shareholders a final dividend of 16 shillings per share following the improved financial performance, taking its total dividend payout for the financial year of 2022 to 22 shillings per share.
We are now in a, if you would call it a BAU operating mode. Of course, during the COVID period, there was heightened monitoring, obviously, of the portfolio. So overall, when you looked at our loan impairment charge, that fell by 38%, to 1.3 billion in the year. And then, obviously, the non-performing book is you have a book of non-performing, and then the ratio is expressed over the overall gross loans. So when in the year we saw that our NPL ratio decreased by 170 basis points to 14.3%. And really we saw the overall non-performing portfolio come down, and then the growth. And really we are not too far off from the industry. The coverage ratio is fantastic because it's a legacy portfolio. We have adequate coverage. Our coverage is in excess of 75%. We had $60 million, good liquidity, dollar liquidity. Our liquidity obviously has improved vastly in the last 10 years. The cost of refinancing, just imagine, the benchmark is obviously the government of Kenya Eurobond curve, and then of course there is the usual credit. So it just is prohibitively expensive. And therefore when you look that we've already amortized, the effective rate even now when interest rates have risen is quite high. So we feel that we could actually, we don't need it from a liquidity perspective, and we can afford to replace it because we are replacing equivalent of $26.7 million of the 40 million because of the amortization.
All right, now remaining with that story on the performance of Stanchart Bank. Earlier on, I spoke to Standard Chartered Bank, that is CEO Karaoke Ngare, on the bank's performance. And you will remember that there has been an ongoing cry by Kenyans about the FX reserves and particularly the dollar shortage. Let's have a look at how that conversation went.
I think in terms of just specifically what we are going through is a very volatile period in terms of what is the availability, how do you balance demand and supply. So we see a bit of volatility. So when you see a bit of volatility in the FX market, then sometimes margins tend to widen, but not insignificantly so. So last year was not different for us in terms of the FX market, and the business did quite well in terms of FX market. Reasonable, when I look at the growth, was about 50% year on year. So we've seen good growth out of that segment. But it's not just because of the trading, it's also the clients who are investing in our wealth business, which is also a big contributor to our FX income, either people disposing or buying new denominated bonds. That has also helped.
All right. Well, let's talk about credit for a minute. And I want to understand what is your current credit quality and what has been the performance over the last 2 or so years?
That has continued to improve. When I look at especially for last year, we see our ECL, significant improvement, 38% year on year in terms of impairment charge. Because for two things. If you remember, after we had put the COVID, to help the clients come through the COVID restrictions and the COVID challenges, most of them came out quite well. The support that we gave them, they've come out quite well. So last year, we started seeing the business starting to pick up. The few ones that struggled, we managed to come up with very good restructuring programs to help them sustain through. So what we have seen is, as businesses are coming back, businesses picking up, the loan impairment has continued to improve. In terms of credit, the demand for credit from businesses is very much tied into the business activities. Because especially for businesses, people borrow when they have something to finance. People do not take facilities just for the sake of it. And as the business has picked up last year, we have seen an improvement. So when I look at the overall shape for our credit profile, it's significantly better than it was 3 or 4, 5 years ago. We've seen it's continued to improve. and that can only get better. We are very bullish about this year. As the economy improves, we expect that is going to continue improving, because then we'll see the demand for credit also increasing in tandem.
All right, now still on matters loan. Now, what is your current loan portfolio composition, and going forward, what is the plan to increase? Because we're seeing a lot of banks moving to the SME sector.
Because of the composition, our corporate business has a big chunk of our loans, because that's when the amount of money we lend to the global subsidiaries, that contributes a big chunk of our lending. Business banking is also a big component as well, because of our SMEs lending. But also personal is quite significant. We're very big on the personal space in terms of clients either coming for mortgages to buy facilities or personal loans. That is another big one. So I would say it's fairly balanced, but a bigger portion to our corporate clients, and then to our personal clients, and to our business banking clients, who are the SMEs.
All right, with regards to these loan facilities, and when you look at the trends in the market, are there specific areas or specific sectors that you are concerned about?
I wouldn't say concerned. I would say there are a few sectors that definitely are challenged. If you look at the hospitality sector, because of what happened, remember that was the only sector that completely shut down in COVID 2020. Completely shut down. That is a sector that still needs help to get out of their feet. In terms of the agriculture sector, because of what's happening today, I think that's also been challenging. But it's all when we get better rains, or the sector of agriculture that is focusing on export, for instance, flowers that don't rely on rain, so horticulture sector, tea, those continue to do well. That's continued to do well. Manufacturing is challenged. This because of electricity costs and supply chain challenges. We see that being an area that is challenged. But also on the other hand, we've got technology sectors, for instance, that is doing very well. Not only attracting investors and foreign capital, there are big opportunities in technology space, whether it's the startups, whether it's businesses that want to scale up as far as technology is concerned. That is doing well. Sectors that are focused on transitioning as well, because of climate risk. When you talk about, let's say, using technology to, like solar, if you're talking about solar, or any of these sectors that are focusing on using technology to help clients save costs, is also doing well. So services and technology are areas that continue to grow, and they continue to do well.
All right, so how would you rate Standard Chartered's efficiency in comparison to your counterparts in the market?
When we look at, I'm happy with what we have seen, the results that we've announced. Our cost income ratio has come down to 45%, which shows that we're getting even more efficient. So I cannot comment on the others; they've not released their full results. But it's an area that we work on very well, that we really focus on. As we said earlier when announcing our results, focusing on the top line is very, very important, but also continue to invest and ensuring that the jaws, the difference between the income and the cost, keeps on to widen, is an area that we are really focused on. And our investment in technology and moving away from expensive transactional channels is one way to continue being efficient. So I am pleased with the journey that we are making, very, very pleased, but it's a journey that will continue. You can never stop.
Are you looking at increasing these customer numbers? Are you looking at tapping into new markets?
The global environment is very uncertain. If you look at Russia, Ukraine, that's a conflict that is widening every day. When it started a year ago, it was just Russia and Ukraine. Now all the NATO partners, everybody is involved in it. So that causes uncertainty. The inflation in the West that is continuing to remain stubbornly high, that is causing the US and the EU to continue raising rates. That affects us as much as sometimes we think they do, because it's very, very far away. But when you see that is happening, it impacts our dollars as well, because then the dollar is, as we say, is going back home. So the investors probably say, I will not take an emerging market risk. I can as well put the US treasuries at a very good rate. That pressure is there. But I think when I see what's happening, as I mentioned earlier, the fiscal consolidation that the government is taking and the revenue mobilization, those two could stabilize the Kenyan economy and provide opportunities. There are opportunities. So despite that caution, we are seeing opportunities in this market. And those are the opportunities we want to continue partnering with our clients to help them realize those opportunities. There's opportunities in technology. There's opportunities in service sectors. PPPs, the government is talking very big about it. It's an area that we cannot participate. So we are cautious, but we are seeing opportunities. And as I use the word resilience, that is very important to add, because that's where when you're resilient, you're able to see, even if despite the turmoil, Where are the opportunities, and can you go for those opportunities? That is what we intend to do.
All right, thank you so much. And of course, we'll be looking at your balance sheet in the coming days. I know some of your partners in the market have been saying they've had this race of trying to get their balance sheet to 1 trillion. I want to understand, where are you before I let you go?
We don't look at, that's not how we look at our business.
Yeah.
As I said, we look at our business in terms of the returns. We don't look at, say, we want to grow our balance sheet to 1 trillion.
Yeah.
Because the shareholders will always ask, what are you doing with the capital that you've got? If you look at it the way we say today, we've got 47 billion of capital. So it's a question of what return is that? What return are you giving me because of that investment? Yeah. So for us, we look at, are we being fair to the shareholders? It's because otherwise, when you do things for the sake of it, then it becomes a big. So the way we look at it is, how efficient are we using our capital? And if there's need, if there are business opportunities that require us to get more capital, then we can do that. But for now, we're happy with what we have.
All right, let's move on to matters Forex now. Forex trading in Kenya is becoming an immensely popular means for traders to invest